Hello and welcome to Bullion Star. I'm Claudia Merkert, and today we have a very special guest, someone I've been looking forward to interviewing for a very long time, Rick Rule, the legendary investor, founder and CEO of Rule Investment Media. Rick, it's such an honor to have you here with us at Bullion Star again.
Thank you. Flattery will get you everywhere. I appreciate the introduction.
Terrific. Rick, the last time we had you on the channel was in December 2022 when Ronan Manley interviewed you. And at that time, the price of gold was trading at around $1,800. Since then, both gold and silver have had incredible gains, almost doubling. And I'm looking forward to hearing your insights on what's happening in the market. Now, a few weeks ago, you held your annual Rule Symposium on natural resource investing in Florida. And from what I have seen in the coverage and the conversations, there seems to be a lot of excitement about the future of precious metals. Would you say that there's been a palpable shift in sentiment towards precious metals since we last spoke in late 2022?
Yes, of course. I remember that interview. I remember the frustration that some of your listeners had with regards to the gold market at that point in time. And I remember rather cheekily saying, when people ask me when the gold price is going to move, I say the year 2000. It was $250 and moved to $2,200. Now, certainly the move since 2022 has been much more dramatic. But I think you need to look at the circumstances that caused that large base build to understand the more dramatic moves that many of us have enjoyed in the last couple of years.
Yeah, right. And do you think that is just the beginning of a surge in interest in gold and precious metals? And do you expect that to continue growing from here?
I suspect, unfortunately, and I'll qualify the unfortunately, I suspect that gold will continue to do well. Gold does well when people are concerned about the maintenance of their purchasing power in fiat-denominated savings products. I think with regards to the world's reserve currency, which say the US dollar, that those fears are very well grounded. I don't fear for the dollar in a relative sense. In other words, I don't think it'll do poorly necessarily versus the pound or the euro or the Canadian dollar or the Australian dollar. But in an absolute sense, I suspect that the dollar repeats its performance in the decade of the 1970s, where over 10 years it lost 75% of its purchasing power. I wish I didn't believe that, but I do. And if you believe that, you need to look at gold's performance in that same decade, where it ran 30-fold. I'm not suggesting, by the way, Claudia, that gold is going to go 30-fold from here. It's already up 12-fold. But I believe over 10 years that gold will more likely than not, the nominal price will mirror the decline in purchasing power of the US dollar. Consequence of that is that, yes, I'm bullish gold.
Okay. And from your perspective then, do you think the West is catching up to the kind of interest in gold we've been seeing in Asia and in the Asian markets? And if yes, why is that taking so long?
No, I don't. Asian buying, at least Asian central bank buying, is a consequence of something that doesn't impact the U.S. as much. The U.S. has basically forced the Chinese central bank and other central banks to buy gold by weaponizing the U.S. dollar, in effect expropriating the SWIFT banking system, which was not U.S. property, by employing the threat of sanctions on the US dollar and US treasuries, and then, irrespective of how you feel about Russia, by stealing $300 billion worth of Russian holdings in US treasuries. If you run a government that occasionally, in a policy sense, runs afoul of U.S. preferences, you need to look at those actions and you need to say, I need to defend myself from that. So in the first instance, central bank buying around the world in gold is often an effort by those central banks to defend themselves from the U.S. The U.S. obviously doesn't need to feel the need to defend themselves from themselves. There's also been a change in China in the sense that Chinese people culturally have had a predisposition towards gold for a very long time. But private gold ownership was illegal. Now private gold ownership is encouraged. I would suspect that there was a deep well of support for gold in China that couldn't be satisfied when the Chinese government felt that gold was a threat to the renminbi. Now that private gold ownership is allowed, there is a deep, deep, deep cultural affinity for China. And remember, too, that China is a society that characteristically saves 40% of pre-tax income. So in addition to there being a proclivity for owning gold, there is also a means to acquire it. Two other attributes sadly lacking in the United States.
So what situation could you imagine that could take place that would shift the West's perspective of gold? Would it have to be a major event, potentially a money reset? Would it have have to be something geopolitical? When will their view change towards gold like it is in the East?
I think it's early on, but I think it's already happening. I don't know that it'll unfold quickly, despite the obvious arithmetic challenges that face the US dollar, and we can go into those later. There's still an awful lot of confidence in the US. The VIX, the volatility index, I mean, is dead. It looks like the electrocardiogram of a corpse. That doesn't suggest a lot of fear. There's a lot of liquidity in the system. There is still a lot of fondness in the US for risk-off assets, small tech stocks, crypto, stuff like that. That isn't an economy that would seem to be dominated by fear. But there are undertones. In the US, we are taught to believe that the correct measure of the deterioration of the purchasing power of US dollars is a government index called the CPI, or Consumer Price Index. And I would suggest to you that that index is a joke. At best, a lie. I believe it for the following reasons. In the first instance, when it's inconvenient, the CPI doesn't include food or fuel. You can't see all of me, but if you could see that I like to eat. An index which doesn't include lunch is of no use to me. Secondly, it doesn't include tax. If I didn't have to pay the tax, maybe I wouldn't complain so much about the index. But commonsensically, if you're an American and you look at the basket of goods and services that are necessary for the maintenance of your family, which certainly include tax, food, or fuel, you will see that the rate of inflation in the United States is nothing like 2.5 or 2.6%. It's more like 7.5 or 8%. And that realization is dawning, the same way that that realization was dawning when I was a young man in 1968, 1969. It took a while for that conclusion to take hold. It probably took 5 years of being victimized by inflation before Americans noticed the gap between what their paychecks bought and what they used to buy. When that perception really took hold in the decade of the 70s, gold went from being an afterthought to being front and center in everyone's mind. Retail flows into gold, as measured by inflows into the gold-oriented ETFs and the trusts, really began between 20 and 22 weeks ago. So the increase that we saw in gold prices on a global basis didn't include US retail participation until very, very recently. And I suspect, really, truly, unfortunately, that it's going to increase.
Yeah, it's interesting you should say that, because obviously you're talking about gold there as being a sort of a hedge and whatnot. And when we last spoke to you in 2022, you described gold primarily as portfolio insurance in that interview. Since then, gold has outperformed the S&P by, roughly 35%, and many are talking about a bull market in precious metals. So has this changed your perspective on gold, and do you see it now as something that should be considered a core investment in a portfolio?
It depends on the investor. A rational financial planner would look at me and say, Rick, you don't need to own gold. You have a gold stock portfolio and you're the largest shareholder in Sprott, which is a brand name for gold financial products worldwide. But I own it anyway, because at 72, it's nice to sleep nights and stay calm. What gold has done traditionally over years has provided insurance. And I would still argue that the primary use for gold in most portfolios is to ensure the maintenance of your purchasing power through thick and thin, particularly thin. I'm also a gold stock investor, and that's different than gold. If you're a gold stock investor, you believe that the increase in the gold price will continue at a pace more rapid than the increase in the cost of producing gold. And as a consequence of that, producer margins will widen, free cash flow will increase, and hence the value of the business, and later the share price will increase. We've seen in the last 18 months that the increase in the gold price has really fattened the margins of the best producers. And they've performed very handsomely. Not the gold equities market necessarily as a whole, but as an example, what I call the golden triumvirate, Wheaton Precious, Franco-Nevada, Agnico Eagle, the three highest quality gold mining companies in the world, have, from a large base, done spectacularly well. In prior bull markets, they run a very normal cycle. The market is led by gold, led by the fear buyer. The momentum in gold does two things. It legitimizes the precious metals narrative, but it also fattens the margins of the best, and they begin to move. When valuation disparities exist between the best of the best and the best of the rest, then the money begins to go down the quality trail. And we're seeing exactly that. This is a textbook gold bull market.
So basically you're seeing your physical gold as insurance then, and you're seeing the equity side of things as more of your speculation or your sort of high-powered performance. Is that correct?
I would suggest that the best of the best are investment quality. Then, when you get down to single asset producers or developers or certainly explorers, you're in the speculative realm. I do all three. I own physical gold as portfolio insurance. In my declining years, I'm increasingly an investor as opposed to being a speculator. But I can't help myself. I love the speculative sector, and I think the money's headed there.
And what percentage of your overall portfolio would you be allocating to your insurance or your physical gold, as you'd say?
My physical gold holdings are, right now, they're probably a bit high. I'd suggest that they're probably 9% of my overall portfolio.
Are you waiting for a particular price? Or do you have a price in mind that you would say this is a price where I need to scale back some of my holdings?
No, what happened is that I bought a lot of gold some years ago, and the gold prices increased. And so gold has outperformed some other components of my portfolio. Particularly, it's outperformed my cash. I've maintained a very high liquidity in my portfolio since 2022. In 2022, I sold a developed real estate portfolio, thinking that interest rates were going to go up, and I was uncompetitive as a real estate investor. And most of that money is still cash. What that means is that gold's weighting in my portfolio has gone up organically without my having to buy more gold, simply because the gold price went up.
That being said, and without a crystal ball, where do you see the price of gold in 5 years or 10 years from now?
I'm going to answer the question a bit elliptically. I believe that the purchasing power of the US dollar will decline over the next 10 years by 75%. And I think that the gold price in nominal terms, US dollar terms, will increase commensurate with the decrease in purchasing power. If you use $3,000 as a base, that suggests a number like 10 or 12,000 nominal US dollars 10 years out. Understand that $10,000 then won't buy you what $10,000 will buy you now. I suspect that gold will at least maintain its purchasing power. It may do substantially better than that. When the investing public adopted the gold narrative in the 1970s, gold did more than maintain its purchasing power. The price action in gold justified the narrative to the extent that investors and speculators, I would suggest, went way, way, way overweight gold. But we're not there yet, Claudia. Sorry to go on, but this is an interesting question to me. JP Morgan Chase, the big American bank, suggests that in the United States market, the market share of precious metals, all precious metals, including equities, is about 0.5% of total savings and investment assets in the United States. So it's a very small asset class. Probably more interesting, they suggest that the 40-year mean market share of precious metals is 2%, which would suggest that if we experience reversion to mean, demand for that asset class would grow fourfold in the US market. On a global basis, they suggest that the current market share of precious metals relative to other asset classes is about 1%, or double the percentage in the US. And they suggest that the 4-decade mean there has been about 2% because of limited Chinese participation prior to the year 2000. But again, it suggests on a global basis that a mere reversion to mean would double demand for gold on a global basis in the face of a fourfold increase in the United States. I don't think those numbers are out of line.
Well, I mean, in the 1970s, we saw obviously the US dollar come off the gold standard and the price exploded. Now there's so much talk around gold and its potential role in a monetary reset, and it's sort of really a hot topic. So some see gold playing a behind the scenes role in a reset, such as revaluing central bank balance sheets, and others seem to be arguing that only a full gold standard would work. Last week, Ray Dalio suggested on X that a US dollar backed by gold is not far-fetched, and Donald Trump Jr. recently mentioned in a paid ad for a precious metals investment firm that his father's administration is exploring the Gold Reserve Act to potentially revalue gold from $42 to current market prices. So what's your take on that? Is this feasible or is this just hype? And could we be seeing some kind of reset that brings gold back to the front and center of the way it was in the 1970s in that way, which could just, drive the price, more strongly again?
Well, mercifully for you, Bullion Star customers can do their own reset. There's no reason why you can't have your own gold standard irrespective of government. Waiting for government to do it seems very far-fetched to me. Two comments on that. The first thing is that people who go into government and people who elect government, frankly, don't want fiscal discipline imposed on them. The purpose of government is to steal from one constituency and deliver to another. That's what it does. Gold eliminates the probability that governments can steal from the unborn. Gold is real money and it imposes discipline. No government wants to be disciplined. They want to discipline other people. The second comment I would make is even in the United States, were they to revalue their gold, take all the gold that's alleged to be at Fort Knox and revalue it from $42 to some higher number, it doesn't do anything for the deficit at all. It doesn't do anything for the creditors either. Let's suppose that I buy some treasuries, some long-term treasuries. By the way, a highly unlikely event, but let's suppose just for fun that I did that. And let's suppose that as a consequence of $37 trillion in on-balance sheet liabilities, that the government experienced some difficulty paying me. Let's suppose now that I pull up to the White House and I say, hey, Mr. Trump, you owe me this money. I'd like my gold. Mr. Trump presides over a nuclear-armed debtor. The probability that I, as a creditor, could request payment in gold is nil, absolutely nil. So to the extent that they revalued it, they are revaluing collateral that a creditor could never seize. Even the central bankers aren't dumb enough to fall for that.
So you don't see a likely possibility? Is this just all just talk, in your opinion?
Yeah, it's
Yeah.
all hype. At my age, you assume they're lying when their lips are moving.
What's your view then on the Bitcoin reserve, and do you see Bitcoin playing a potential role alongside gold in some kind of future role? I mean, I know we've got Judy Shelton talking about, gold-backed bonds and this kind of thing. It seems to be almost coming into reality just by the constant talk about this. And obviously President Trump seems to be agitating behind the scenes. He seems to like gold a lot. And, the fact that his son's talking about it, does this mean anything for you, or is
You
it
used
all
a good
just still
word.
rhetoric?
Claudia used a good word. It's talk. A Bitcoin reserve. What kind of reserve? In the United States, I can't speak to Great Britain, but in the United States, our on-balance sheet liabilities exceed $37 trillion, or $30 trillion net of the Fed's own balance sheet, 30 trillion net on balance sheet debt. But the off-balance sheet liabilities, according to the Congressional Budget Office, exceed $100 trillion. Now, interestingly, the Internal Revenue Service, similar to your inland revenue, estimates that the private net worth of Americans, assets minus liabilities, is $141 trillion. So let's look at the reserve math. Collectively, we're worth $141 trillion, and just at the federal level, we owe $130 trillion. That 130 trillion that we owe is growing by 2 trillion a year on balance sheet and another $2 trillion a year off balance sheet. So what reserve? We're $130 trillion upside down. The reserve, if it exists, means that they are printing specious currency units and using them to buy Bitcoin, if that exists. It's not a reserve. It isn't the creation of wealth. It's the creation of a distortion. As to the potential competition for investor interest between Bitcoin and gold, that's a very interesting question. It's worthy to note that the market share of either asset class is less than 1% of total savings and investment assets worldwide. So the relevance of each to the global financial situation is akin to the relevance of a pimple on an elephant's behind. They don't matter. They may matter to each other, but I suspect there's plenty of room for both. I suspect myself, people are attracted to Bitcoin because of its price escalation. People who look at its utility probably think of it more as an anonymous medium of exchange, which is very attractive, to be honest. Gold is also potentially an anonymous medium of exchange, but it's much, much, much less utilitarian. You can get Bitcoin across a border in a cell phone. Getting gold across a border is a bit more challenging. So I think that's a much more interesting question. I don't see a backed currency simply because the history of governments has been, unless they owe the money to somebody more powerful than themselves, they don't pay. Why would you, as a politician, subject yourself to discipline when you ran on the specific promise to be undisciplined? And why, too, would you constrain yourself to creditors when you have guns and they don't?
Yeah, I like that.
Cheerful, aren't I?
So I take it Bitcoin's not firmly on the top of your investment portfolio.
When I was young, I invested in any asset class that was amusing to me, and I got spanked for that. Now I invest in industries that I think I understand and where I think I have a competitive edge against most participants. So I invest in natural resources, the whole range of natural resources, and I invest in conventional financial services, not fintech, nothing like that, but insurance, community banking, wealth managers, asset managers. I've been involved in both of those businesses for 50 years. I'm not a technology guy. I understand the basics of cryptocurrency. I've invested a fair amount in technologies around trading commodities, including gold and the blockchain, but I wouldn't describe myself as knowledgeable enough to own Bitcoin, so I don't.
Fair enough. Rick, I'd like to move on from gold now and get your take on silver. Well, gold's been firmly in the spotlight. Silver's been catching up fast and keeping everyone patiently waiting. It's recently finally moved in line with gold with around 30% gains year to date and over 80% in the past 3 years. Given silver's history of outperforming gold in certain cycles, what role do you see it playing in a long-term bullion portfolio, and how should investors balance their potential upside with the downside risk of silver?
Silver is probably the place, the asset class, that the speculative precious metals adherent should be participating in. I've been through 3 precious metals bull markets in my life, and they follow very predictable patterns. The gold, physical gold leads because the fear buyers first. When the momentum is established, leadership changes from gold to the senior gold stocks, and we've just seen that. At some point in time, the momentum in the precious metals price verifies the precious metals narrative to generalist investors, and and the generalist investor comes into the market. When that happens, leadership changes from gold to silver. I'm not sure why it does. I suspect it's because of the lower unit cost or perhaps the reputation for upside volatility. I don't know that it does, but I've observed that it does. And when that event happens, you won't need Rick Rule to tell you. We won't be talking about a move from $36 to $38. We'll be talking about a much more dramatic move. And I have a lot of confidence that will occur. I have no idea when. And the truth is, I've stopped caring when because the moves are so dramatic that the rent your portfolio gets paid on its silver holdings justify the time that you spent waiting for it to occur. The very small population of viable silver companies does even better because the consolidated market cap of that sort of silo of reasonable quality silver equities is so small that when the generalist investor tries to crowd into it, the market caps simply can't contain the money. In my first bull market in the 70s, watched Coeur d'Alene mines go from 10 cents to $65. I was too young, too dumb, too poor to participate. But the second precious metals bull market I was prepared for. We had two horses in that race, Silver Standard, which went from 72 cents to $45, and Pan American, which went from 50 cents to $45. They were extremely pleasant events for a young man. And I'm hoping to repeat that sort of fortune, maybe not with the same percentage gains, but I'm hoping to repeat that fortune, that sort of circumstance in this market. And I'm fairly confident that that will occur.
And so, I mean, silver's both a monetary and an industrial metal. In your experience, which side's going to drive the price more in the next 5 years?
Monetary.
Do you think it's the monetary speculation?
Monetary, yeah, absolutely. And I've watched the last three markets, and none of them had anything to do with the industrial side. The truth is that gold does well when people are afraid. And that's usually, in terms of the broad economy, a counter indicator. It has been, in terms of its dramatic moves, always a monetary phenomenon. It's useful to the monetary case that the industrial case exists because some silver is destroyed in industrial processes. It's supply that goes to supply heaven. Damn near all the gold that's ever been mined, we do a weird thing. We take it out of a hole in the ground called a mine. We put it in a hole in the ground called a vault. But we actually use silver. Some silver goes to silver heaven. It gets destroyed as a germicide or it gets used in a solar panel. It doesn't get recycled or something like that. And so you have circumstances where the industrial utilization of silver exceeds the amount of silver newly produced in the market, either via direct mine production or co-product production or recycling. We're in the midst of one of those periods today. But in my experience, not going back to the beginning of time, but going back 50 years, the real dramatic increases in the silver price are always monetary.
And you mentioned that you could imagine if gold sees what it saw in the 1970s, we could see price at $10,000 an ounce. What could you imagine for silver if the same thing happened?
I have no idea. I mean, I honestly don't. I know that makes a bad headline. When people talk about the former all-time high price in silver and they quote $50, that's a huge mistake because that's assuming constant dollars. You need to talk nominal dollars. My suspicion is that if you inflation adjusted that $50 number, you'd come out with a number closer to 150. I think people make a mistake with the headline prices that they assign silver. I don't like to do that anymore. I don't like to get people too excited. If you give people some number, they ignore the rest of the interview and focus on the number. And I think that's a mistake. I think people need to familiarize themselves with the entirety of the subject of gold and the entirety of the subject of silver. If you give them a number to cling on, they forget the why. And they can easily get shaken out of a good position that they should hold.
I agree with that. That's really interesting insights. Thanks. I'm curious how you are reading the current state of the markets overall, given this year we've seen some really notable moves from billionaires and major funds selling stocks, sitting on cash and increasing their gold exposure. We've seen Jeff Bezos selling over $6 billion of Amazon stock since June. Warren Buffett's holding over $300 billion in cash, and Bridgewater's now reduced its S&P 500 exposure to less than 10% while increasing their gold holdings. What do you make of these trends? And do you see them as signaling any changes ahead for the stock market?
In the very, very near term, I think the stock market's in okay shape, simply because there's so much liquidity. The investors I know, the family offices that used to be my clients, are awash in cash and looking for ideas. Real concern in the near term, as expressed by the VIX, is nil. This is not a market, an equities market, that people are afraid in. There are some people like Buffett who are opportunity constrained. Buffett is famous for saying that the market isn't a topic. It's merely a facility to buy and sell fractional shares in good businesses. And I think he's had a rough time the last year and a half finding businesses that were selling at prices that he felt like he could pay. It may also be that he's making a market call. He's famous for talking about the difference between the market capitalization, the S&P 500, and the GDP of the United States. And by that metric, the markets are horrifically, according to him, overpriced. My own constraints are really that, as I say, I sold a developed real estate portfolio because I thought with interest rates rising that the wind was no longer in my sails, and I haven't been effective at redeploying it yet. My portfolio's done fine because I I happen to, buy the kind of stocks that have performed extremely well in the last 3 years. As for Mr. Dalio, he's an absolutely superb speculator, and you need to pay attention to what he says. But I don't think the early movers like Dalio and Druckenmiller are reflective of the equity markets in the next few months at all, simply as a consequence of the fact that there's way too much cash and there's way too much confidence. One other note on that, there's a lot of political pressure in the United States to lower the interest rate, despite the fact that, according to the politicians, our economy is in very good shape. And despite the fact that even their fraudulent index of inflation is in dangerous territory. If they were to lower the interest rate meaningfully, or if they were to make several small rate cuts, I think savers and investors around the world would say American society's resolve to defend whatever integrity is left in the US dollar has been abandoned. And then I think you'd see the anti-dollar trade, including gold, get very, very strong. I saw that at the end of 1975. You won't recall because you were probably unborn, but if if born
That
too
wasn't
young.
far away.
At the beginning of 1975, inflation was a political issue in the United States, and the Federal Reserve and Congress expressed some resolve to move the interest rate closer to the inflation rate. They raised the interest rate, and that cratered gold for 9 months, cut the price in half. It also cratered the Dow, obliterated the long bond market, and stopped housing starts in their tracks. Congress and the Fed lost their nerve at the end of 1975 and cut the interest rate despite persistent inflation. And that was the game on signal. In 75, the gold price fell from $200 an ounce to 100. Pretty ugly decline. Shook out a lot of the faithful. And when it was game on, the gold price went from $100 to $850 in 5.5 years. If they make a meaningful cut in U.S. interest rates in the teeth of inflation, it'll be a signal to savers and investors around the world that U.S. society and the U.S. political class has abandoned any intention to defend the integrity of the dollar. And you'll get a romp in gold.
I mean, you've navigated multiple market cycles and helped so many investors. And with the experience and wisdom you've gained over 50 years, Rick, for someone starting out learning about accumulating precious metals, what advice would you recommend to someone who wants to try to emulate your success?
Read a lot. I mean, a lot. Don't take my word for anything. Use everything I've said as a suggestion that you should study more. Remember that your biggest investment risk isn't in Washington or London. It's conveniently located to the left of your right ear and to the right of your left ear. Remember, too, that your time preference doesn't matter to markets. You may want something to occur in 6 months, but 5 years is a much more realistic time frame. And in addition to being patient, you have to be persistent and tenacious. My really big speculative stock wins, 10 baggers, 20 baggers, 30 baggers, have all taken 5 or 6 years to unfold. And they have all exposed me to 50% share price declines during the period of time I owned them. So in addition to being patient, I had to know enough about the investments that I didn't get shaken out by some pretty ugly price declines. So that isn't the kind of advice a young person wants, is a 10-cent stock that's going to go to 30 cents before their birthday. I don't do that stuff. You got to invest in yourself. You got to invest in your reputation. You got to invest in your knowledge. And you know what? You got to save. You cannot be solvent if you aren't a capitalist. And you can't be a capitalist if you don't have capital. And you can't get capital if you don't save. So a minimum of 10% of pre-tax income, no matter what. I don't care if you have a fancy night out or drink Starbucks after you've saved 10% pre-tax. Boring advice, but it works.
Yeah, look, as an accountant, I'm all with that advice. So it's just really inspiring to hear how your disciplined habits and careful learning have really shaped your career. And I think our listeners often underestimate how much consistency and a long-term mindset really matter, and not just knowledge. Now, Rick, I understand you're launching a bank. Could you please tell us a little bit more about that?
I am, and thank you for asking. By the way, when your time comes to retire, don't start a bank. It's not conducive. to retirement. I'm delighted to say I've failed retirement completely. So back to the bank. The story really goes back to 1999 when a group of us started a bank called EverBank, which was one of the first American online banks, a bank with no branches. No branches is useful because mostly branches serve no useful purpose, but they cost a bank about 150 basis points in non-interest expense. Saving that 150 basis points, we could pass it on to our borrowers and our shareholders, which was very useful. And we grew that bank over 14 years from zero to $28 billion in assets before we sold it. The people we sold it to abandoned our customers, which is interesting. They did it for their own reasons. They had their own customers. But at any rate, we had built over 14 years a 275,000 person customer base who were abandoned. And so after a while, we decided to go back and serve that customer base again. So how will Battle Bank be different than other banks? First of all, again, we'll be branchless. Your computer, your phone will be our branch. If you aren't competent with a computer or a phone, please use another bank. There are lots of banks out there for dumb people. We don't want to be that bank. We will pay interest. There's several $1 trillion on deposit in the US in accounts that don't pay interest. We'll have one high yield money market account, no fees. If you want to write checks, God bless. In other words, we will pay you interest on your checking account. I think most people that deposit money would like to be paid interest. We will do that. Most of our competitors don't. We will only lend to industries we understand. We don't purport to be all things to all people. Big banks try to lend against 1,000 industries, which is why their loan loss experience is so high. We will lend in industries that we understand, and we won't borrow short and lend long. We won't put ourselves in the position that's a savings and loan industry that Barclays, that Silicon Valley Bank put themselves in. Further, what we will do is we will be the first bank in the United States to offer retail credit facilities to gold and silver holders. If you have gold or silver in segregated accounts at Brinks or Loomis, which is to say custodians that are publicly traded so that we know that the vault is solvent, we will establish credit facilities against those. JP Morgan Chase does it too, with a $10 million minimum, which isn't useful to many mortals. But we will do it initially with a $100,000 minimum. We hope ultimately over time to bring that minimum down to $20,000. Unlike our competitors, we consider gold and silver to be good collateral. They trade 24/7. If for some reason you decided not to pay me, I could send your collateral to collateral heaven. I could get paid and give you the balance. Try to do that with a second mortgage on a duplex somewhere. It turns out gold and silver is superb collateral. It also turns out that lending money to the gold and silver community or allowing people to save money in 20 currencies rather than one exposes us to a constituency that I've served myself for 50 years. And that means that our customer acquisition cost, other than wear and tear on my old carcass, is very, very low. When we started EverBank, our customer backlog, the people who had before we opened announced their intention to do business with us, was zero. At Battle Bank, our customer backlog is closing in on 18,000 people, which means that our customer acquisition cost for our high yield savings products, our multi-currency savings products, or our gold lending is very, very stout. So given that we have low customer acquisition costs and low operating costs, we'll be able to pass the benefits of that cost savings onto our shareholders, onto our borrowers, and onto our depositors.
When will we see the launch of Battle Bank?
We expect to get final regulatory approval next week.
Oh, wow.
You know, we tried for 4 years to open a de novo bank, which is what we did the first time. The first time it took us 19 months. After 50-something months this time, at age 72, I didn't know how many months I had left. So we went and bought a little bank. And rather than applying to open a new bank, we're applying to put more capital into an existing bank, something that we've been assured by the regulators is not something that they object to. They like solvent banks. So we would now expect that we'll have regulatory approval very, very, very soon. After that, we'll shake out our systems with some tolerant depositors like me to make sure that everything works, and then we'll open to the public.
Well, that's super exciting. We'll be following your launch and we wish you very much success with that. Rick, thank you so much for sharing your time and insights today. Hopefully we can have you back on the channel much sooner than 2.5 years. And thank you so much for your time.
I thank you for the opportunity to have the discussion in front of your audience. And I look forward to visiting again whenever you deem it to be convenient and valuable to your audience.
Thanks, Rick. If you found this interview valuable, be sure to like and subscribe to our channel for more content. And if you'd like to receive 10 grams of silver for free, you can sign up in our link in the notes below. Thanks again to our audience for joining us. I'm Claudia Merkert from Bullion, and I look forward to seeing you next time.